Hello and welcome back to The Note. The focus this week remains relentlessly on emerging markets and particularly their currencies. The question is, can we avert contagion of the kind that we saw back in the 90s? Now, we all know that the local markets in the emerging markets have developed very greatly. We're no longer just talking about souks in Istanbul, we're talking about big, deep, sophisticated local debt markets. Is that going to help them stave off contagion? With me now to discuss this is an expert in the field. He's the Chief Executive of Spiro Sovereign Strategy, Nicholas Spiro. Thank you, Nicholas, very much for joining me today. Let's start by taking a look at perhaps a slightly surprising chart which shows you how various emerging currencies have fared so far this year. We can see that in fact the Hungarian forint, of which we've heard very little, has actually devalued more against the dollar than the Turkish lira or the South African rand. What is happening here? That's a concerning development, isn't it?
Very. I mean, this is very troubling, considering that the forint, in fact, was one of the strongest emerging market currencies during the May to August phase of the sell-off.
So the taper talk test that they all had, it passed.
Well, it certainly passed it, and it passed it with flying colours, as did the zloty to a lesser extent. The ruble was obviously falling then, but what we actually see now is almost a complete new reversal in terms of sentiment towards emerging European currencies, in particular the forint. Now, a lot of this is obviously sentiment driven, but there are very important idiosyncratic risks. In particular, the fact that we have an extremely dovish central bank, which seems to be determined to cut interest rates further, despite the fact that the forint is very weak, and that obviously causes a risk to the economy given the very high levels of foreign currency denominated debt. But inflation is very low in Hungary.
But they also have a current account surplus, don't they? I mean,
now that's what's particularly worrying, is the fact that the sell-off is actually now broadening out to those markets that actually have current accounts surpluses. Obviously, it's very important to stress that it is still the current account deficit countries,
like Turkey,
like Indonesia, like South Africa, whose currencies are obviously under the cosh. But I think that clearly what we've seen over the past week is that Turkey's extremely aggressive interest rate hikes have opened a new leg in this sell-off, and
it's demonstrated panic in some ways.
It certainly feels, and it looks like a rout. There is a pervasive bearishness towards emerging market assets, the likes of which we've certainly not seen since 2008.
Okay, now let's take a look at some of the mechanics of the sell-off. This is how purchases of or accumulations of emerging market bonds went over the last few years. You can see the dramatic turn in direction at taper talk time last year, and so far we're looking at net outflows so far this year. What's driving that? Is it largely the Fed, or is it about the emerging markets?
Well, as you've been commenting on for some time, if you look at the equity space, obviously EM stocks have been out of favor for quite some time. But as far as the bond market is concerned, the moment that the Fed let the tapering genie out of the bottle, we saw a collapse in inflows, and clearly after roughly almost 100 billion worth of inflows into EM fixed income in 2012, we saw them dwindle to 6.2 billion. We've got roughly 3.5 billion in outflows this year. That's half of the inflows which were recorded last year. So a dramatic sea change in sentiment.
Okay, now let's take a look at the mechanics of who's been doing the selling. The green line here is the strategic mandates of large pension investments, and the red blocks here are more retail investment. This implies to me that we need to pin an awful lot of hopes, or people in emerging markets need to pin an awful lot of hopes on those big institutions. Is that right?
Absolutely. I mean, this is a qualitatively and quantitatively different investor base for emerging market fixed income to the one which it was in the late 1990s. This is not some exotic asset class, although it may feel like that for some of the retail investors. The most reassuring aspect of this of this sell-off is that institutional money, real money, the pension funds, the central banks, the insurance firms are sticking with emerging market debt. If you look at the size of the emerging market fixed income universe, you see that local debt markets account for the bulk of the asset class. There's a lot of local pension funds, local insurance money, particularly in Asia, which obviously is providing support to the asset class at a very difficult time, picking up some of the slack possibly.
Okay, Nicholas, thank you very much indeed. Ultimately, obviously, there are still many reasons for concern about emerging markets. The positive sign at the moment is that the institutions hold their nerve. The moment when we should all get very worried indeed would come if those institutions were to lose their nerve.